Hi, Mike. Thank you so much for joining us today, and it's great to have you with us. So, there's obviously a lot happening right now across energy markets, geopolitics, and broader macro conditions. So, I'm really looking forward to walk through your framework and what you think actually matters most at this point in the cycle. To start broadly, if oil tanker traffic through the Strait of Hormuz remains disrupted, what is the likely timeline for recovery? Weeks, months, or over a year? And what key trigger points could restore normal flow?
I think the key thing as we record on April 2nd is the statement Mr. Trump made. He said similar that he would hit Iran hard for the next 2 to 3 weeks. Now, if they still have offensive capability, even after this weekend or within a week or two, that's a big problem because it's already a shocker that the strait was closed. First thing for, I never thought that would happen. I didn't think the U.S. military would then get to happen. Major faux pas, but it is. And now, to me, it seems more like the battle of the bulge. It's something that we'll get over, we have to move on, and just hit it with harder and harder military action until you can subdue the offensive capabilities of Iran enough so the strait can be open. So that's the number one thing in the next couple of weeks. I think this weekend's key. If we come in Monday morning, there's no major attacks from Iran, that's a major sign. We'll see, but that's all that matters right now. But the market's really looking forward to, first of all, this is a pretty significant trigger, I think, for global recession. The key thing to remember about crude oil, it's typically its own worst enemy. It goes up. When it goes up at this velocity, it brings on more supply, curtails demand, and tilts the world over to global recession. And that's a tilt I see right now. And you're seeing the wealth destruction, the demand destruction, particularly in the stock market. So, and if it lasts, I think the key theme will be similar to what we did in 2008 when crude oil really spiked to 147, is it brought the whole economy down. And by the end of the year, it was much lower. That's been the signal for natural gas so far this year. Natural gas this year is up 100%. That's U.S. And now it's down on a 1 year basis. It's down 30%. To me, that's where things are going.
That's really helpful, especially in terms of how to think about timing rather than just headlines. So I want to zoom out a bit because you've been framing this not just as an isolated shock, but as a part of a broader cycle. So which historical period does 2026 resemble more in your view? The demand collapse of 2008 or the supply shock volatility of 2022?
All the above. I go back to 1990 when Saddam Hussein invaded Kuwait, big pump in crude oil from about 18 to 40 and then back down to 18 within a few months. I remember that one well. Definitely 2008, similar 2022. The big difference now is where markets were before this happened. We were most complacent and most expensive stock market almost ever on a 100-year basis. And then I look at very low volatility. And that's also what happened last year. And it's what gold warned us. Gold had its best year last year since 1979. It looks like a pretty good significant peak. And when that happens, it was really weird. I was lucky enough beyond that trade, but I'm like, this usually doesn't happen without it mattering in the future. And also we had that collapse in crypto. So what I see happening in the macro is a trigger for pretty significant post-inflation deflation, which we're way overdue for. You basically have been seeing that in China for a while. We've already had that cycle kick in already this year. We've had some major pumps and dumps. We had Bitcoin was up about 10% on the year and collapsed. Now it's down around 20%. Same in copper was up about 15% on the year. Now it's down. Silver was up 63% on the year. Now it's down. Gold was up 25%. Now it's barely up. See the trend there? Now it's crude oil's turn. The problem with crude oil, when it breaks things when it goes at this velocity. So things are breaking. And I think even if we wake up in the morning, find out the strait is resolved instantly, we'll have a pretty significant relief rally in risk assets and a pretty significant collapse in the front crude oil contracts. Back months are already pricing for this to not last long. But I think it's a trigger for that global recession. And certainly if this endures, we'll almost certainly get a global recession, which means deflation eventually.
Yeah, that comparison is really important because it shapes how we think about what comes next. And that brings up a word that's been coming up more and more in conversations recently. So what about stagflation in 2026? You've said Brent above $120 is its own worst enemy. Could fertilizer or other secondary shocks create a cost push inflation dynamic that overrides your thesis?
Oh, sure, it could. But I think we have to put this in the context of where we've come. Remember, on the back of the biggest money pump in history in 2020. We've elevated all risk assets. And we've already had significant inflation. What we have right now in the world's second largest economy is significant deflation. You look at that Chinese 10-year note, I've been pointing this out for a little too long, but it's at 1.82%. That matters. That means something. That's despite significant fiscal and monetary stimulus running 2 to 3 times what you're seeing in the US. So they're doing everything they can to support their economy and exporting pretty significantly deflation forces, most notably in technology, renewable energy technology that's replacing fossil fuels. And what's happening now is going to accelerate that process. That's one thing I really enjoyed writing about in 2022. But this one is global. This event is global. I mean, just having price of European diesel head towards $200 a barrel is a sign that this is going to be pretty significant demand destruction. I mean, what capital investment decisions in the world are not being curtailed? What consumer on the planet is going out of the way to, hey, honey, I'm going to buy more stuff now or buy a new car? It's all being shut off. This is a classic, I think, psychological trigger for shutting down of your consumers on a global basis, in particular in this country. Remember, before this happened, consumer sentiment in this country was already pretty weak. Retail sales versus CPI were already pretty weak. Unemployment was ticking up. To me, this is a trigger. And the bottom line now is gold warned us, and the stock market's very expensive. The bottom line I was noticing is stock market volatility was just way too low. Now, it's still too low. It's picking up a little bit, but 180-day volatility in the U.S. stock market is still running near decade lows. That's to me just way too low for this environment. So my base case is starting to happen, and that stock market volatility should go up, which means a downward trend, which means all that matters. And what better trigger than the world's most significant commodity, which should use its own worst enemy, rallying at this velocity. So to me, this is as bad as it was in 2008. When I remember my signals were similar then, was when we reached $4 a gallon in U.S. gasoline for the first time. Everything, that was the trigger. That was in July. And I'll put that in context. That happened in July. Crude oil reached 147 and CPI peaked at 5.6%. Right now, we have CPI, our analyst, Anna Wong, thinks by the March CPI is probably going to pop up to 3.4%, which is about half of what it did in 2008. It's just early days, but history can repeat and can rhyme. This is a rhyme, but the difference back then, I think, was back then the stock market was running about 1-to-1 versus GDP. Now it was earlier 2.3 times. So that's why I'm kind of fixated on that. And like when people for the last year or so would ask me about industrial metals and they put a bullish case about copper, I'd say, okay, so you're bullish the stock market. Or if they give me a bullish case about cryptos, I said, so okay, you're bullish the stock market. And they would ask me sometimes, why did you say that? Because that's all that matters. Now, for those, almost all these assets, almost all risk assets, certainly copper, crude oil's the triggers, and you have to expect the stock market to go up. So this is, to me, is that trigger for everything to kick in. And we've been warned, like gold warned us last year. So where do we go from here? I think this is a year to be looking to just be risk off and hang out in treasuries.
Yeah, so if we take that framework seriously, it's not just about commodities in isolation. And the next question is how that pressure actually moves through the system. Regarding your crocodile jaws analogy, if commodities drop as you expect, how quickly could this volatility migrate to an overextended S&P 500?
Well, that's the key thing. In 2008, the Bloomberg Commodity Index peaked around up 30%. This year is up about 26%. And that's a good thing for commodity investors. It also shows you the value of holding some commodities in your portfolio for insurance, but typically it doesn't stay up. For instance, the Bloomberg Commodity Index total return right now is the same level as it was in 2007. Now, that's only 20 years ago. So it goes up, it provides insurance, and typically it creates that cycle and goes right back down. So that's the key thing I want to point out is this is what we're seeing in crude oil right now, but these type of patterns are happening with the U.S. accelerating its stance as a pretty significant surplus producer. Energy, natural gas, crude oil, liquid fuels, ethanol, corn, soybeans, and wheat. And what's this doing for producers? You can see this in the forward curves. It's not just crude oil. All the forward curves are lower and significantly lower. Now, that usually happens in this environment, but the key one I'm really watching is like that December crude oil future. It's running around $72 a barrel right now. That's the one that's going to be front month by the time we get to the midterms. And that's the stuff that matters. But all the markets are looking forward to this being a cycle that higher prices bring on that supply, reduce demand, and also help curtail consumer spending on the macro picture. And that's what the market's starting to look forward to. I think it's legitimate. So that's the point, is if crude oil were to stay higher and go above 120, that's where your trade is. Those back months potentially picking up. And I doubt that's going to happen.
Yeah, that transmission piece is critical, especially given how tightly different asset classes having been linked. So I also want to stay within the commodities for a moment, because we've seen more pretty extreme moves recently. Gold, silver, and copper saw parabolic moves followed by a sharp reversals. Does this volatility indicate a kind of liquidity exhaustion that could precede a broader market break?
That's one way to look at it. I just look at gold as gold was the kind of market I was fundamentally, technically bullish for decades, gold. And once in a career, a market tells you to sell, and that's what gold did. A little bit last year, I think that was a little bit early, but certainly in February. It reached its highest ever versus a Bloomberg Commodity Index. It reached almost a 50-year high versus its 60-month moving average. Now you can go from a 200-day out to 60-month moving average. It's stretched. Not just gold, but silver too. Those markets said sell. To me, it said sell, thank you. But usually these things happen in extremes when people pile on. It's the classic human nature. People pile all the fundamentals that we pointed out years ago. And that to me was the warning. But the theme is typically now gold and silver this year probably put in highs that might last for, if history's a guide, decades. Now, years would be okay. To stay above 5,000 gold, above $100 silver, I think would be a bit of a shocker, but that's unlikely. But the thing is, they front ran this event. It doesn't matter to me whether you believe that or not, but all that matters is the price on the screen. And they did. And if you're in that market and you made some good money, you probably should be selling when they're yelling. And that's what happened. But now it's about, what do they mean going forward? So for instance, when you have a velocity of rally like this in gold, you overlay it with the stock market, almost always the stock market peaks. Now, I do that with S&P 500. You go back to 1980 and it shows you it's the indications you get from markets. So I see that volatility trickling over the stock market, and that's still my key theme. It's volatility is just still too low in the stock market. S&P 500 down about 4% a year is wonderful. I fully expect this to be the start of the third 50% drawdown in the S&P 500 since 2000, and we have very good, worthy reasons to do that. Okay, it was the most expensive versus GDP in about 100 years. We had credit spreads the narrowest in about 20 years, and now we have this worthy catalyst for just some normal reversion. So if you look at things like a 20-quarter moving average, which is 5 years in the S&P 500, it's around 5,000. It's normal reversion. Right now we're 6,500. That to me is what's starting. But if that happens, that's going to be all that matters. When beta goes down, all correlations go to 1, and Bitcoin warned us. Bitcoin, by collapsing last year and cryptos collapsing last year, were kind of they led the way up, and they're leading the way down.
And finally, I want to come back to something more grounded in the real economy, because this ultimately feeds back into growth expectations. You set hard ceilings for corn and soybeans. In a slowing GDP environment, is there any realistic scenario where those levels break higher, or is the downside now the more likely path?
Well, the significance of corn and soybeans in this country is we have a demand problem. I've been to a lot of conferences the last few months, and the number one issue in the U.S. is getting prices higher. Now, this has been the gift. Getting corn in there $5, that's where the December contract got, and getting soybeans in there $12, that's where that November contract got to near that levels. What farmers were dreaming of, and most of them sold forward and said, thank you, I'll bring in more supply. So we have a pretty significant glut of corn supply in this country from last year, with this massive glut of soybeans coming out from Brazil, 180 million metric tons. That compares to maybe 10 years ago, it was only 100 metric tons, which is about the same as the U.S. Now they're taking off. So the theme is the two key sources of demand from the U.S. are either exports, that's kind of hard because Brazil's really taking over that area, or biofuels. What is biofuels? I mean, more supply of liquid fuels, more supply of ethanol, and we already have a glut of that. Now we're exporting that to the rest of the world, but that's to me where the theme is. So the number one thing I think will make in mostly corn prices, which is the most significant agricultural commodity, to stay higher this year, is a U.S. drought. out. Now, I can't predict that. It could happen. I don't think it's usually they're unlikely events. And that's my point is typically when you get these pumps in prices, producers sell forward and bring on more supply. Now, it's clearly happening in the oil patch right now. They're selling forward and bringing on more supply. Rinse and repeat. We'll see where this comes out. And if that's the case, and with the stock market potentially goes down, there's your post-inflation deflation cycle kicking in. And I fully expect that by the end of the year, by the time we get the midterms, that crude oil contract, the December crude oil contract, which is right around the low 70s, is going to be more likely to be closer to 50 or 40 than near 100, because 100 is a recession, 50 or 40 is a normal reversion. And by the way, the number one theme here is, what does Mr. Trump want? And I think it's more likely he's going to get that. Lower energy prices, lower interest rates. Unfortunately, he might also get a recession.
Thank you, Mike. Thank you again for joining us. And this was a really sharp way to think through not just what's happening in energy, but now how it connects to the broader macro picture and where the real inflection points might be. So I really appreciate your time and insights. And thank you for everyone for tuning in. We'll see you next time on BERYL Elites.
Thanks for having me.